Have you ever wondered why stock markets often rise or fall before the economy shows any signs of change? Investors do not react to what is already happening, they anticipate what is coming. Market prices reflect expectations, predictions, and early signals long before official reports confirm trends. In this video, you will learn why markets move ahead of economic conditions and how understanding this can give you an advantage in protecting and growing your wealth. Like and subscribe to learn how to anticipate rather than react. 1. Markets are forward-looking. Financial markets are inherently predictive. Prices of stocks, bonds, and other assets are determined not by current conditions, but by expected future outcomes. Investors constantly analyze trends in corporate earnings, employment, interest rates, consumer behavior, and global events. These predictions are priced into markets immediately. For example, when analysts forecast slower growth, stock prices often decline even before unemployment rises or GDP contracts. Markets act as a collective brain, aggregating millions of predictions, expectations, and assumptions into a single price. 2. Investor expectations drive movements. Expectations, more than current reality, are what move markets. If investors anticipate a slowdown, even if the economy appears strong today, prices may drop preemptively. Conversely, the expectation of recovery can lift markets before economic indicators confirm improvement. This predictive behavior is driven by analysis, sentiment, and risk assessment. Collective expectations form a consensus that often diverges from the present economy. 3. Leading economic indicators signal change. Markets respond to early signals known as leading indicators, which often move before the broader economy. These include metrics like manufacturing orders, consumer confidence, building permits, stock performance, and interest rate trends. Investors monitor these indicators to gauge future growth, demand, and corporate performance. Unlike lagging indicators such as unemployment or GDP, which report what has already happened, leading indicators give clues about the direction of the economy. 4. Corporate earnings forecasts influence market timing. Companies often provide forward guidance on expected earnings, revenue growth, and strategic plans. Investors price stocks based on these projections, not just current profits. If a corporation signals strong future earnings, its stock may rise even if the economy is weak. Conversely, downward guidance can depress stock prices before macroeconomic reports reflect slowing conditions. Market participants interpret corporate forecasts as early signals. 5. Policy expectations move markets in advance. Monetary and fiscal policy decisions influence market expectations long before their effects are visible in the economy. Signals of interest rate changes, quantitative easing, tax reform, or government stimulus affect investor behavior immediately. For example, a central bank hinting at tightening can depress equities and lift bonds before GDP growth slows. Conversely, stimulus announcements often spark rallies ahead of any measurable economic impact. 6. Psychology amplifies early market movements. Investor psychology intensifies the predictive nature of markets. Herd behavior, fear, and optimism can accelerate price movements in anticipation of economic trends. If participants expect a downturn, panic can drive rapid selling, causing market declines before fundamentals catch up. Similarly, optimism can fuel rallies ahead of actual recovery. This self-reinforcing feedback loop magnifies early market movements. 7. Global signals influence domestic markets. Domestic markets are interconnected with the global economy. Slowdowns or growth in major international economies, trade developments, and geopolitical events influence expectations and market pricing well before domestic economic indicators reflect these trends. For example, a slowdown in China or Europe can impact US stock prices before domestic GDP is affected. 8. Volatility acts as a leading indicator. Periods of heightened volatility often precede visible economic changes. Sharp swings in equities, bonds, or commodities frequently signal shifting expectations, risk reassessment, and uncertainty about the future. Volatility is an early warning system, reflecting adjustments before official data appear. Investors who understand this dynamic can interpret spikes or sudden dips as signals to adjust exposure, reallocate assets, or hedge positions proactively rather than reacting to reported economic shifts after the fact. 9. Market movements reflect opportunity and risk. Market prices adjust continuously to balance perceived risk and opportunity. When investors anticipate weaker conditions, selling pressure increases. When recovery is expected, buying increases. This preemptive pricing ensures that markets move ahead of reality. For disciplined investors, these early movements provide clues to undervalued opportunities or overexposed risks. Anticipating rather than reacting allows portfolios to grow consistently and reduces the emotional impact of sudden swings, transforming market behavior into actionable insight. 10. Anticipation gives investors an edge. The key lesson is that markets move before the economy because they constantly incorporate expectations, forecasts, and signals. Investors who anticipate these movements rather than waiting for economic confirmation gain a strategic advantage. Understanding this forward-looking nature helps position portfolios, manage risk, and identify opportunities ahead of the majority. Markets act as an early warning and opportunity system. Those who comprehend how and why they move can navigate cycles with foresight, turning prediction into consistent long-term success rather than reactionary losses. Markets rarely wait for the economy to catch up. They anticipate trends, price in expectations, and reflect collective predictions long before official reports confirm reality. Investors who understand this dynamic can act strategically, protect capital, and capitalize on early signals. Like and subscribe to continue learning how to interpret market movements, anticipate economic shifts, and turn foresight into long-term wealth.